fall below 50% or more. Okay? And again, we don't know what their value is because they're not traded very much until you see trading going on. And this is why you're not going to know what they're worth, and this is why the Obama administration is trying to, they call it public-private partnerships, somehow get private money involved. So they're giving a gift to the investment bankers and hedge funds and equity, whatever firms that are interested, by saying, you know, put up some money, we'll put up a loan, and you can buy these things, and if they go down in value, you don't have to worry. It's kind of like a gift. The idea is it's a very expensive gift. It may not be the right way of doing it. Okay, so think about that. The second one is even more important. This is about trust. I said before, the banks don't trust each other, and they still don't trust each other, although there's some evidence that interbank lending is increasing in the United States and in Europe. You know, part of this trust is actually just knowing that the bank doesn't have the toxic assets, but it's very difficult to prove that you don't have toxic assets. Maybe what's toxic today may turn toxic tomorrow. The price of the underlying asset drops another 20%, then it's suddenly toxic. And that's why some people think the banks should go dump this stuff in a bad bank, put it in some quarantine, like a virus. Put it in some quarantine and let it sort of do its thing there. This is all about creating trust, because presumably if a bank gets rid of that stuff, it'll say, look, I'm free, I'm not toxic, you can lend money to me, and I'll lend it to somebody else. I can do what banks normally do. But trust is one of these public goods. So it depends on what everybody else is doing. It's not enough just to have one bank that's trustworthy. You've got to have a bunch of trustworthy banks, and you can't really buy that back by reducing interest rates. So I find this really interesting to go back to the Roosevelt era. If you look at what the President of the United States in 1993 did, he had to go on the radio. So the radio was the internet of the 1930s. Okay? People actually would go to their neighbors who could afford a radio, and they would sit around and listen to the president talk, because that was like the most current information you could get. And in 1933, even before Roosevelt took office, people were nervous about their banks. People like you. And when you're nervous, you go to the ATM and get some money, right? If you all did that, we would cause a crisis in Berlin probably, because there wouldn't be enough cash on hand, and then the Landesbank would get upset, and they'd have to bring out the trucks, bring out the troops, and but back then, this was a serious problem. This is a picture of Germany, by the way. This is the Darmstädter, I can't even read it anymore. D&N Bank, okay? These guys had a crisis in 1930, and that spread all over the world. These pictures were incredibly terrifying for a lot of people, just like our pictures of the Northern Rock episode in England made Germans very nervous, and the chancellor had to go on the radio and the television and say, this is not a problem, don't worry, we're going to take care of everything. But I'm talking about the banks now, the banks trusting themselves. This is also a confidence problem. So in 2008, we have a problem that banks don't want to lend, and you can see that by the spread in interest rates between the banks' loans that involve real transactions and those that involve derivatives. Okay, so the so-called OIS interest rate is the one that's kind of, it's a synthetic product that you can define as a swap between banks of interest proceeds that doesn't involve any transfer of capital. It makes sense that you don't care, if you're not going to lose the money. If you give the money away to somebody, you may not see it tomorrow. And that's why this interest rate, this blue interest rate, is so high compared to this red one. So that's the crisis of confidence we see in 2008 and 2009. So, last lesson. Okay? This is for people who don't have a lot of economics. Okay, but it's always fun to do this. The financial system is so essential, and this is why it's systemic. So you may not like bankers, but we need the banks. We need someone to do this function. Because, these folks have the money. They may be rich people, they may be poor people, but they all have money that they're going to put into some good use because they can't use it immediately. So in the real world, they put it in the bank. And a bank doesn't have to just be a bank. It can be a Sparkasse, it could be a savings and credit union or whatever, a credit union. It can be a hedge fund. Rich people don't have banks anymore. They go to hedge funds. Okay? For some people that's been a mistake, but those are like banks. They're no different, really. They just do stuff that's not regulated. They do stuff that's really wild and possibly very profitable, possibly very risky. Okay? Insurance companies also fall into this category. Okay? Believe it or not. In fact, there are lots of different institutions, and they're all sort of dealing with their individual customers and clients, and they have excess funds and they have to pass them on. So this is why the interbank market is so important. If this thing dries up, then you have lack of confidence, and Berta's graphics work. Okay, watch this. And then they just evaporate. And the consequence is that any player in the financial market that has a net inflow, what does she do with it? She takes it to the central bank. So in the ECB terminology, the balance sheet has gotten longer and longer because banks that have lots of cash inflow don't want to lend it in the interbank market. They certainly don't want to lend it to foreign banks. They're going to put it in the ECB. So this is a real interesting issue because it creates a lot of problems for central banking. Okay, and again, let me just summarize what's happening now in the United States. I'm a bit over time. The U.S. now has a real economic crisis. It's not just financial. We can blame Wall Street, but it's actually a problem for Main Street. And if you remember from macro, there are two types of policy that are macroeconomically effective. One is monetary policy, so you can reduce interest rates or you can raise them. Sometimes they don't raise them and reduce them at the right time. Sometimes they wait too long. But right now, it seems that monetary policy in the United States is no longer effective. At least traditional monetary policy, reducing interest rates, does not work because banks don't want to lend and people don't want to borrow. People are downsizing. Okay? And if that's the case, it's very difficult to jumpstart an economy like this. So you may be skeptical that policy is possible at all, but even if you like policy, this is not going to work. This is why fiscal policy is happening. In America, they've now, with the, I would say actually a fortunate turn of events, a Democratic administration with a Democratic Congress is able to get it through because it wouldn't have gotten through under a different set of conditions. The largest fiscal stimulus package in history. Okay? I think I made this remark, I'm not sure I can back it up. The last time this happened was with the Romans. Okay? So a big military campaign, the Romans, that was big fiscal policy. If you divide it by GDP, it's probably comparable. But we've never seen anything like this before, in absolute terms, obviously, but also in relative terms. We're talking about 2 to 3, in peacetime. In peacetime. So let's cross our fingers about that. We're talking about a mix of tax reduction, that's federal taxes. We're talking about a very large increase in spending for infrastructure, education, energy, and health policy, all conditional on the president getting his packages through. It's very hard to increase spending even in a parliamentary democracy. In America, it's much more difficult because Congress has a mind of its own. The president cannot dictate terms to Congress. He is not the legislative leader of the party. He can propose legislation, but the Congress has to approve it, and the Congress is accountable to the people. And if the people don't like it, if people are mad about taxes, then this will be difficult to get through. The most interesting part is about a fifth of this is aid to the states. America's states are in bad shape. California, Minnesota, New York. These are states with lots of people, fairly liberal public services, and no money. Okay, when Uncle Sam, when the federal government loses tax revenue, Uncle Sam can borrow. When a state loses money, loses revenue, the state has to cut spending because states cannot borrow to finance ongoing expenditures. States can only borrow in the United States to finance capital expenditures. At least that's the theory. Okay, so this is an issue in itself. So California was very close to insolvency a few months ago. Schwarzenegger was pretty nervous because he doesn't have a friendly legislature to deal with. They don't like him, although I think he's okay. I think he's pretty liberal for a Republican, actually. There is some evidence that this will work, so I'm going to try to convince you that there is some hope that this massive stimulus will actually help bring the U.S. out of a very severe recession. So if you read the paper in a year and you see U.S. economy is growing again, you'll say, well, Berta was wrong. This is not serious. No, it's probably growing because of the Obama plan. Lacking the proposal, lacking the stimulus package, things would be much worse. And if you need evidence of that, look at the Great Depression. Look at when Roosevelt raised taxes in 1937 because he thought it was the right thing to do. The recession was not over yet. Okay, the reason I say this is because after 9/11, the big surprise that I talked about earlier, that was a surprise for everybody. And the biggest surprise was that the government of a Republican administration would increase spending by 8% in real terms in the military and defense security sector. That's public expenditure that takes place immediately. It's discretionary but not political. Every American airport got a new Federal Transportation Safety Board administration and technical equipment. That blue line is the jump in the growth of spending on this stuff after 9/11. And that obviously, if you read the papers, had an effect on all the stocks that were selling this stuff to the government. Okay? And this also created a lot of confidence, so it's a little bit difficult for an econometrician to sort that out, but it's clear that this recovery might have had something to do with that because the recession had just begun. Okay, the recession that started in 2000, defined by the NBER, was reversed fairly quickly. So I think that's good evidence that fiscal policy can work. It need not always work, but in this particular case, it may. The bigger problem is how to get the banks to trust each other. We can talk about this maybe in the end of the talk. The excesses in lending are at the root of the problem. And the excesses of lending were an essential ingredient for this crisis. Cheap monetary policy, low interest rates were also an essential element. And we see problems right now. We see an increase in liquidity in the American system. We see a very large increase in non-loaned funds. So there is a risk that we have another one of these bubbles, in fact, very quickly. The most important thing that hasn't been dealt with is regulation. Can I give you an example by just talking about these guys? This is an American company, the largest insurer in the world, sitting on a ton of capital. Especially the reserves, the provisions of an insurance company are huge because insurance companies deal with paying money out when bad things happen. Now, AIG came upon the idea, why don't we activate this money, right? We've got all this capital, let's activate it. So let's guarantee, because we're so big, we'll just guarantee the bonds of Fannie Mae and Freddie Mac. No problem. Okay? Now, in doing so, the banks punted their capital. They basically put it on the line, trying to get that high rate of return. And AIG Financial Products was based in London. It was beyond the reach of the US regulator. It was in London. And it was issuing derivatives in France. So it was like doubly out of reach of any regulator. People didn't even know this thing existed. They knew that AIG Financial Products was making $1 million a year per employee, including the secretaries. This was a very profitable operation, but only as long as the bubble goes on. It was a risky operation, and this type of activity has not been addressed by the recent reforms that are on the table, and it wasn't addressed in the G20. Everyone's talking about regulation, but no one's doing anything. And I don't think the market can solve this problem. And I hate to say this, I'm kind of a free market guy, those of you who know me, but I don't think the free markets can solve this problem. As much as I would hope that Ordnungspolitik and, Ordoliberalismus would be able to solve this problem, I just don't think we can do it, because you can always go to the Cayman Islands and replicate AIG Financial Products. And there are enough crazy people who are going to move money there and borrow from people like you and me. The crisis will happen again. It won't happen in real estate anytime soon, but it could happen in other types of activities, other types of assets. I'm also concerned that bailouts are preferred to more regulation. So the recent Obama initiative, which has been advised by people like Larry Summers, which is basically to leave everything the way it was, just write it off to bad information, not to devious, misleading misinformation, but rather to just bad bad decisions on the part of one or two executives, not to blame executive compensation for this, because the executives at this AIG Financial's products business were making a ton of money. And they're not paying their bonuses back. They're not in the United States. They're not going to have the lynch mobs outside their houses. So this is not good for restoring confidence. So I disagree with a lot of analysts in the United States who criticize the Europeans for insisting on regulation, because I think regulation is important to restore confidence. It's important to restore confidence. If you get a regulatory regime, people will finally, well, the government's taking care of it. It's got to work out better than it did over the past 15 years. Okay? It has to be intelligent regulation. It shouldn't be stupid regulation. Okay. Again, some random reflections. I'm worried about the banks. I'm also worried about increasing market power of large firms. One of the interesting things about the recession of the Great Depression in the 1930s was that small companies disappeared. Big companies survived. And the best example of that is to look at the auto industry. Going into the Depression, there were many, many automobile companies. And Henry Ford had invented the assembly line and they'd perfected it and all that kind of stuff. But during the Depression, companies like GM got very big because they bought up the losers. And the losers were losers because they they couldn't sell their cars anymore. It's not clear it was because their products were bad. So why do you think we have Chevrolet in the United States or Dodge? These are brands, but they come from firms that actually existed in the 1920s and 30s. And you see similar things happening with banks now. You see banks getting bigger and bigger because Merrill Lynch, what's that, a brand? Those are banks. Those were banks, very large banks. So that kind of consolidation is also happening in the market for software. Okay, so I fear this might actually have a problem down the road. And there's also the problem of protectionism. We know that Americans are very open people, but Buy American has been said, and I hear it here in Europe too. Once you start doing that, you're going to lead to more problems down the road, because every country depends on, in a globalized market, every country depends on imports and exports to exist and to make standards of living better. Okay, I'm about finished. It's probably too long, but financial markets tend to be 2 steps ahead of the regulators. This is a classic problem. So checks that you write to your friends, no one writes checks anymore, but if you did write checks, in the 1870s, you would have been considered kind of a dodgy person, because it was an innovation. It was something new, and it was unregulated. But a person like J.P. Morgan could write a check for $1 million, and a person would take it because they knew there was something to back it up. Okay? Or you could write a check on a good bank, and the banks, if you could identify this person, show some ID, then the check would get cashed. Okay? That was a financial innovation. Problem is, these financial markets are very clever. They're populated by very smart people. Some people I went to college with, unbelievably clever. And this cleverness is unfortunately not funneled into making things, but it's funneled into making ways of getting money out of your pocket into their pockets. Okay? And you can make that positive by saying that this intermediation, it would not have happened otherwise, but to a large extent it is really just trying to get money out of people's pockets. And I'm concerned that we're not addressing this sufficiently. There are some medium-term risks, and I'd like to tell you those before I stop. Economists are very good at talking about this stuff, especially ex post. My friends love to make jokes and tease me about this, right? Economists are very good at creating models of what happened, but it's very difficult to be predictive. Well, I think a lot of people predicted this. Nouriel Roubini, Robert Shiller. I wouldn't say that I did it, because I'm not a financial economist. But in one of my lectures in 2003, I showed those prices. If you're in the Grundstudium, maybe you remember it. Economists can see the picture, but it's hard to call it because people are behind the picture. People are the ones that make the markets change. And a lot of that's based on emotion. It's based on greed. It's based on trust. And it's based on euphoria. So if you have time, buy this book. This is written by John Kenneth Galbraith. Again, I said this already. And he's not a friend, and he's dead, so I'm not promoting his, I'm not getting a commission on this. It's a short history of financial euphoria. And he describes, basically, a situation in which people sort of get very greedy, and collectively so, because they see all their friends doing it. And that's something we economists are not very good at describing. collective euphoria, collective madness. Madness. And there's a book in the 19th century, Madness of Crowds. You know, it's about this. And something economists are not very good at describing. We can describe the profit maximization motive. We can write down a nice equation, maximization problem, value function. But in terms of getting the timing right, we're still not very good at this. And there is a bubble coming, because he said so in 1993, and he got it right twice. He was dead, and then we had the internet.com bubble, and then in 2006 we had the financial crisis related to real estate. So it's going to keep happening. Okay, it's just kind of an inherent thing. I'm worried about the dollar. Okay, so I'm kind of worried that this whole thing is kind of a bubble in itself, because in a sense the valuation of the US dollar is based on confidence. And as soon as a lot of people abroad start worrying about the United States, the dollar may lose some value. And this, of course, will cause inflation. Now, how this happens is your guess. Your guess is as good as mine, but I remember when I was a kid, in 1971, the Bretton Woods system collapsed. And that was caused because the French and the Germans and the other Europeans were complaining about financing the Vietnam War. They were buying American debt. Americans were running deficits to pay for Vietnam. And what happened? Well, eventually someone started selling the dollars, and the Bretton Woods system of fixed exchange rates collapsed. Right now we have the Chinese doing the same thing. It's not quite fixed anymore. They say it's moving around, but in fact it's the true valuation of that currency is anyone's guess. It must be much higher than it is right now. The Chinese don't want to admit this, especially since they've got a problem. Okay, they're trying to do their own stimulus package because they're suffering, but this is a very serious issue. And I think if anything's going to trigger inflation in the United States, it's going to be a sudden depreciation of one of the central exchange rates with the United States and the concomitant change of commodity prices in dollars, like it did in 1972, in 1973, and 1974 with wheat, oil, and related products. Who's to blame for this? Okay, Maggie asked me to finish up with this, so I'm really kind of late, but I have to do this, okay? Whose fault is this? Okay? You know, is it the politicians' fault? A lot of people say the politicians didn't regulate properly. So there's a lot of Germans out there who believe in the soziale Marktwirtschaft and Ordnungspolitik and all that kind of good stuff. So they say it's basically the regulators' fault for not putting their foot down. There's a point to that. But again, you got to be smart. You got to be Larry Summers on the other side. Okay? I keep saying Larry Summers. He was one of my employers when I was an undergraduate at Harvard. I know how smart this guy is. Okay? So you need to have someone that smart anticipating the next financial market disaster. Now, if you knew how to do that, why not try to make money off of that? Right? Why should you help the government? So the US government has a problem. Every government has a problem regulating. So politicians are prone to be captured by those who would regulate. Politicians are late anyway. They're just listening to the voters, and the voters are not working in the financial markets. A lot of people blame corporate governance. The stockholders of the banks should have started raising questions. You know, is this sensible to do this? It's our capital. If you were a shareholder in Citibank, hello, you just lost 90% of your money, at least. You know, so why didn't they catch on before? Why didn't someone tell Ackerman, hey, you can't promise 25% rate of return on equity. Just because those Americans are doing it doesn't mean that you have to do it. But then, you know, that's why I think this guy is right. If enough people are willing to believe that the markets in the world have changed, let's do it. And maybe you can get out of the musical chairs game before the music stops. And there's at least one banker who's actually said that. When the music stops playing, then it's time to find a chair. A lot of people blame me for this. So a lot of you have come to me and said, it's your fault. I had nothing to do with this crisis. Okay? And I know I'm teaching you this stuff and you think I'm a priest or something because I'm so religious about it, but you know, economics is an attempt to describe people's behavior with respect to the allocation of resources, why this is mine and not yours, right? That's what economics is all about. And you can have a planned economy, you can take it from me, or we can cut it in half, but it's all about producing and dividing the goods and the financial services. Okay, so that's you can't shoot the messenger. You cannot shoot economists for this, because economists were out there, people who do this for a living, already saying, hey, there's something wrong here. Okay, and I can, it's not my field, so you can't blame me for not writing about it, but I have lots of people that I've talked to who saw this coming, like they saw the Japanese bubble bursting coming. But you got to do something, so what are you going to do? Keynes had the greatest quote. He said, if the market is irrational longer than you are liquid. Actually, he said solvent. That means that you can bet against the market, but you may lose your shirt, because the craziness in the market may last longer than you can keep your borrowed position. You're short selling some stock, right? Okay, I'll finish with some quotes. This is great. Speculators may do no harm as bubbles on a steady stream of enterprise, but the position is much more serious when enterprise becomes the bubble on a whirlpool of speculation. And that was Keynes. Okay? Keynes had a lot to say about this. This one is one I like. There's nothing in economic life so willfully misunderstood as a great speculative episode. So if you look at the discussion in America that's taking place about the recent crisis, it's amazing how many people are willing to deny what I just said today. And if you look at this book, in 1929, Paul Warburg, who was one of the founders of the Federal Reserve System, actually said, this has gone too far. Too much short-term speculation, too much margin lending for the stock market, too much leveraging. Back then the idea was to create an investment fund and use the capital gains to leverage up another loan to buy some more stock. Okay? You know what happened to Warburg? They said, you don't understand modern financial markets. You don't know what's going on. And a lot of people actually, one guy, it's actually in the book, one guy said, my bank will step in. If the Fed doesn't want to reduce interest rates, I will reduce interest rates. So, if you want to buck the system, you have to deal with that kind of criticism. It's a great book. I really do recommend you looking at it. Thanks for your attention, and if you want to have a little question and answer, otherwise let's go have some champagne. Thank you. Anybody have a question or a remark or comment?
With comments, so what happens and what do you think will happen with countries, not Europe and not United States, but
yeah, okay.
Because the crisis affects these countries in different ways.
Right. Yeah, that's a great question. So the U.S. has this problem. The Chinese have a U.S. problem. The Europeans have a U.S. problem. And then you've got the third world. The third world was, or the developing nations as they call them now, the developing world had no great interest in the U.S. They weren't holding lots of U.S. Collateralized debt. Okay, but they're being affected. And how are they being affected? Well, because the recession causes a drop in demand. It causes a drop in the demand for their products and a drop in the price of their products. So what we've seen recently is a big drop in all commodities prices. And I think you can attribute that to the recession that we're seeing right now. Now, of course, if you believe what I said, this will be turned around in the next recovery. I think we're going to see much higher commodity prices in dollars. So, but the question is, how do what do you do? And that's why the IMF, I think one thing the G20 could agree upon was increasing funding for the IMF to help countries in trouble. Okay? But again, it's an increase, a large increase, but the question is, will it be enough? I can't answer that.
I understand what happened after the real estate bubble burst, but I don't really understand why the real estate prices stopped rising.
Yeah.
Something happened and suddenly the prices were falling, and then it's really understandable why everybody tried to get out of this market.
Right. The cheap way for me to answer that question is to say what I said before, which is economists can't predict when. They just predict that. But that's unfair. I can tell you what I think happened. The U.S. was going into a recession anyway. Okay, so the U.S. had a very large expansion. So macroeconomists kind of understand that the probability of going into recession increases dramatically as you move out beyond 5 years. It's just like the probability of Getting married goes down dramatically after you get to be 40, okay? If you're not married already. So it's the opposite for the recession. But if you look at this picture, I can show you that you can see that interest rates started to rise. The Fed began to realize that they were creating this huge wash of liquidity already in 2004. And they started to raise interest rates. And Greenspan was coming under criticism from some of the people in the Fed who were called hawks, the anti-inflation people. And so you could argue that that was the trigger, this controlled, measured rise in interest rates. So people were borrowing on adjustable rate mortgages that were literally so low, and they were going to trigger an increase, raising the money market rate to 3%. It was just going to have to happen. It's based on LIBOR or some other interest rate. And as soon as that happens, these are ninjas, right? These are the no income, no job. So those marginal people go off and they start selling, and that's enough to break the bubble. No one knows why the tulip bubble burst. But all they knew is that afterwards, a lot of people were eating those tulips. They weren't even planting them anymore, right? A lot of the marginal assets were really not anywhere close to being worth what they were being priced at. Okay, so now you see a lot of empty houses in California, a lot of empty houses, rows of empty houses, streets. So, it's clearly psychology. I can't do it. I can't do that.
Write the title of the book on the blackboard?
Yeah. If you come to the reception, I can show it to you. I'm not going to give it to you because it's out of print. You have to go to Amazon.com. See, otherwise I would be making money on this. I would order a reprint. But I'm not a very good economist. I would have done that, actually. This book has been out of print for literally 15 years. But I think it's going to start getting reprinted, actually. So it's A Short History of Financial Euphoria by John Kenneth Galbraith, who's a very, very left-wing economist. So I didn't like this guy when I took courses from him. He was incredibly arrogant, I mean, like some professors, like me, I don't know. He was very, very problematic. But the guy was on the money. So, yep.
Professor Bauer, you said you are concerned about possibly more inflation in the near future. Is that in the US, or does it include the Eurozone? In other words, how do you assess the independence of the European Central Bank?
Yeah, okay. The inflation, we haven't had many episodes of inflation in the United States diverging radically from the European situation. Let me tell you why I think in the 1970s they moved together because the oil price, the price of oil went up by literally 200 to 300% in 1 year. Now imagine what would happen if that happened today. That would be oil going from 50 to say $200 a barrel in a very short time, meaning that suddenly you have shortages and people are speculatively buying gasoline and producers are hoarding gasoline because they get better values later. This caused prices in Europe to go up a lot. Okay, so and European, the European trade unions were much more powerful actually than they are now. They're still pretty powerful, but they were able to ask for very large wage increases to compensate for that. So if you had relatives who were alive in 1974, like me, you will remember that the public sector union in Germany asked for a very large wage increase. I think it was 8%, and they got pretty much what they wanted. Okay, so a lot of people said that was inflationary. So these things could happen. If we had a big drop in the value of the dollar, an increase in the price of oil, it's not clear whether the euro price of oil would go up. The invoicing of oil in dollars doesn't matter, because if the euro rises against the dollar, it negates this effect. So I don't think this event will lead to it. Now, of course, if the European Central Bank continues to lower interest rates and create the same kind of excess liquidity that you're seeing in America, you might have the same conditions. A lot of Europeans are nervous about this. I think the European Central Bank is much more conservative on inflation than the Fed is. Of course, they're under pressure now because of the recession. Okay, but it's it's speculation. It depends on a lot of circumstances. It depends on whether they reduce interest rates over the next 6 months or not.
Do you think that the current volatility in the stock market is still because of the loose regulations and too much liquidity in the markets?
Because I think that the institutional investors are still playing the same game to make big profits and be back on the right track.
I can't judge that. I'm not a finance expert, but I will say that this does happen. We know that. We know that, I mean, the people who get listened to, right? You have to be listened to. People don't pay attention to me. But if Jim Cramer gets on television and says, you know, you got to sell General Motors today, people will sell. And then, you know, I don't know, Jim Cramer's not supposed to be doing the opposite. But if he's you know, not exactly ethical, he might be doing something like that. These kind of people can move the market. And again, I'm an economist. I like to think that things are happening because a lot of people are doing stuff. I don't think individuals do this, but I do think there's a lot of uncertainty now. There's a huge amount of uncertainty. So you see it in the valuation of options. It's gone up because there's a lot of risk. You see it in the valuation of these products. So people are trying to buy these derivatives still, right? It's like buying an insurance on a house that you know that's going to burn down, right? So they're obviously very expensive. And I think now if you bought them, you'd probably lose money. But I can't deny the possibility that some manipulation is going on. But again, I'm not an expert. I just think the underlying risk has increased, and it has to have, right?
One question: do you approve the measures that are being taken by the current US administration, and which of them do you approve of? And what do you think should be done?
The current...
It's been criticized hugely by conservatives in particular.
Yeah.
What do you think about that?
Well, I think I said this already. I think the administration's fiscal policy is... What happened to it? It's gone. You know, this is a very large measure, okay? And he's pulling all the stops. So he's cutting taxes. That should make some Republicans happy. He's bailing out the states, which should make everybody happy. And he's also increasing infrastructure, which America needs. And these are actually possibly high productivity investments. Okay, so, you know, insulating a house actually has productive value. It saves energy and increases, in effect, it increases the value of the house. It increases, in some sense, it would increase GDP, especially if people are spending the money on that stuff, on products that are made in the United States. What I criticize is the way they're dealing with the banks. Okay, because I don't think the administration is independent enough to do this. This is just my personal opinion. I don't think there's enough independent advice being given. The current Secretary of Treasury was the ex-president or the ex-chairman or the governor of the New York Fed. So he's obviously, you know, he knows the financial markets very well, and he's not, I don't think he's going to take a measured response that would put this sector at any risk. I do think that nationalization should not be ruled out. This is a very un-American thing to say, but you know, if you think about this public-private partnership, if that doesn't work, you've literally thrown out billions of dollars to the dogs.
This conception of bad banks and good banks.
The bad bank, yeah. Well, the bad bank is controversial. Again, a lot of people would say that's kind of the Japanese problem. And one of the reasons the bad bank is a problem is because it's kind of an open admission that if you can do this, you can get away with it. Okay, it doesn't really correct the underlying problem. So you're basically doing something that's really very, very unprofitable, and then you're just selling the junk to the government. And the government is socializing the losses. You could say the same thing about the public-private investment plan, whatever it's called. Except you might want to try to make the banks bear more risk in the case that it doesn't work out. But of course, the banks have the money. You can't, unless you nationalize them, you can't force them to do this, you see? And most importantly, I'm worried that the governance system hasn't changed. So the situation that led to this crisis has not been addressed. Again, I'm just worried about that because people are talking, as I said, people talk about everything but the cause of what happened. People don't want to talk about that. Okay? So. Anybody else?
Remember, in 1997, there was already a
huge financial crisis in Southeast Asia.
Yeah.
So I'm curious about what are the differences between this current financial crisis and what happened in 1997? And should we have already learned some lessons from 1997 financial crisis in Asia?
Well, that crisis was caused by other things. Okay, the crisis, the Asian crisis, was caused by a run on Asia. People thought they had gotten the lending to Asia had gotten out of control. And the irony is that people aren't really sure which Asian country was really at fault, because some very solid countries like South Korea, which was growing very fast, and you could argue that Taiwan didn't deserve to be hit by the crisis. Thailand, Indonesia, Malaysia is kind of an interesting question in itself. Hong Kong, right? There was a massive pressure on the Hong Kong dollar. People were selling the Hong Kong dollar because they thought they would give up and they could make tons of profits. It's a classic story. And they failed because Hong Kong kept the. It's a different situation. Maybe it had something to do with mistrust in a deeper sense. Maybe it was a different kind of bubble. But it didn't have to do with real estate, and it didn't have necessarily to do with the habits of American savers or investors. Okay, I think it was different. Although you did have this run, you had this sort of sudden withdrawal of funds from the stock markets and ultimately the central banks of those countries fixing their exchange rates. So it was a run, crisis of confidence, but it's different. I think it's very different from what we have now. Yes?
Do you think America is going to be first in, first out of the crisis?
First in, first out. Oh, that's a good question. If this works, it'll certainly help. My view is that America has this fundamentals problem. The fundamentals are this big mass of debt. That's bad. One way to get out of this crisis is to have some inflation. Okay, no one wants to talk about this. It's certainly not something Obama wants to talk about. But a classic way of getting out of a debt problem is to inflate the problem away. So you basically generate enough inflation to make the nominal value of the houses high enough to make the mortgages worth something again. A great example of that is my father's house. Okay, my father bought a house in 1971 and paid $55,000 for it. The house is probably worth $300,000 or $400,000 now. It was the greatest investment he ever made, because inflation, he borrowed at 5%, and the inflation rate over the 1970s was well in excess of 5%. And that's exactly what happened. It was kind of a gift to him. It's a gift to those people who borrowed on fixed terms, in fixed nominal terms from somebody else. Now, the loser is a person who lent. So you might say, well, those guys deserve to lose anyway, right? Those hedge funds and banks, But again, we are partly part of the banks. We lend money to the banks because we have deposits there. So it's very complicated. But I have a feeling that the inflation option is attractive for the United States. So just objectively speaking, don't be surprised in 3 to 5 years that we'll have something like that down the pipeline. Whether it's first in, first out is a different question. I don't think Europe has the fundamental problem that the United States has with this overvalued real estate, but I think it has other potential problems. One is that it exports to the United States. So as long as the United States isn't having a problem, the Europeans have a problem. So we'll have to see. Okay, I think that's enough talk. Oh, you want to have one more? One more. Oh, I'm sorry. Oh, look, somebody I know.
I'm interested, how do you judge the real threat for the real economy? In particular, 2 questions. The potential breakup of global supply chains. Did you say that small companies where we outsource to are
right? Yeah.
And second, due to market psychology, a rise of trade barriers.
Yeah, sure. I mentioned that. It's one of my classic points I mentioned. The Depression A lot of people, it's a big debate, a lot of people disagree on this. A lot of people say the Depression had nothing to do with trade. One thing that's interesting is in 1930, the United States passed a law called the Smoot-Hawley Tariff Act of 1930, which effectively raised tariffs on a bunch of foreign countries. Now, this happens to you, the obvious thing to do is to retaliate. So the Europeans retaliated, and then the Americans retaliated, the Canadians went in. So as a result, everyone had really high barriers, but nothing had changed basically, except no one was trading anymore. We can't do that now because of the GATT, or the successor, the World Trade Organization. But what we can do is have national stimulus packages, national bailouts. So it's interesting, most countries, Germany has tried very hard to avoid this. In America, there's been some rhetoric, but I think in general, there's no law against giving a contract to a foreign company. But on the ground, it's going to remain to be seen how this money is spent. And why should the Americans stimulate the Europeans? The Europeans aren't stimulating them. Yeah, I mean, this is a classic argument that people will raise. Now, inside of Europe, it's a different story, because Europe is like a bunch of U.S. states with semi-open borders. Okay, and some countries are sharing the same currency. So it makes sense for the European governments to coordinate a fiscal expansion. So I think it's really important that France and Germany and Italy not only coordinate their spending plans and their tax reduction, they should also coordinate their protectionism. They should not do it. But we see the Italians and the French agreeing on some fighter plane, and the Russians have a rebate program for automobiles made in Russia but not made, it's tricky. I mean, it's dangerous, and it's a slippery slope. It can happen in slow motion over many years. And the end of the game, because we are in a globalized world, all the clothes were made, are made in China or in Mexico, and who wants to go back to buying $700 suits, or $700 shirts, because we have to retool the shirt production industry in Germany or the United States. It was be kind of stupid to do that. So the gains of free trade are enormous, and the loss of those gains are not visible to most normal people who don't think about it every day. Okay, so anybody else? One more question? Yes, last question, and then we'll have some Sekt.
A lot of your work was about labor market, so how do you judge the situation on the German labor market in the next months? Where will the figures?
Yeah, Germany is going to have some problems because unemployment is already high on an international dimension compared to other countries. And, on the other hand, the Germans have a lot of shock absorbers. They have Kurzarbeit, they have this short-time working, they have a very generous social insurance system, and they have a generous system of unemployment benefits. So the short-run gain of that is that the political unrest because of unemployment will be less. But the longer-term risk is that if some structural change is involved at the same time, this structural change will be dragged out. I don't see that being a problem. It was a problem in the 1970s. Because what happened in the 1970s was that the whole world moved a lot of manufacturing to other places. And Germany didn't do that. So they tried to keep manufacturing longer, and they kept it into the 1980s, but they got rid of it anyway, right? So you might argue that maybe they shouldn't have done that. They should have done it at a different rate. I don't see that kind of structural change happening because Germany already had structural change in the 1990s with Eastern Europe. So a lot of outsourcing already occurred. If anything, some stuff will be coming back. You might see call centers coming back to Germany from India. I don't know. It's just an idea. Okay, time for some champagne. You want to ask me afterwards, or? Okay.
Quite similar problems in Sweden and Japan. So how come we didn't learn from those situations? Because we had kind of a certain lecture.
It's in the book. Now, individuals, you get up and say something in the middle of a financial boom, and people just laugh at you. People laugh at you, or they try to hurt you, right? So the people who criticize the dot-com situation, they said these companies are overvalued. So, you don't understand. You don't know what you're talking about. This is the future. And of course, people are cowed into this acceptance. And again, that's psychology. You can write down the equation to value the asset, and it's only supported by incredible growth rates. And that's exactly what happened in Sweden and exactly what happened in Japan. I went to graduate school with somebody who wrote his dissertation on Japan. He published it in 1988. The guy's name is Peter Boone. He's an economist with the IMF now. He predicted that the Japanese price bubble, the house price bubble, would collapse. People thought he was crazy. He didn't get a decent job. He had to go to the LSE. Oh, I shouldn't say that. He didn't get a decent job in the United States.
But how come we're not able to find a solution to the whole thing? Because we've seen Japan do this like 10 years with that bank system and so on. So at least we're looking right now to find something inclusive for all of us to solve the whole thing.
Again, this book will take you 2 hours to read. It's a lot of fun. He's incredibly, like I said, he's got a very arrogant tone, but you read it and you say, man, he's right. The guy's right. It's all in there. Okay, thank you very much.